Hello, in today's video we're going to look at risk management, money management. In Forex it's called position sizing. We will see the impact of position sizing in the very video. We will still again see how we do this practically, that is on our platform, which is MT4, and then also TradingView, and then we will physically see how we calculate our position sizing or risk management per trade in the easiest way possible when you're trading Forex. My name is Sewankambo Isma. Thank you for subscribing, liking, sharing, and also commenting. Well, when it comes to risk management, we're looking at an aspect of actually knowing how much we are supposed to calculate, how much we are supposed to risk. Remember, trading is a business, just like we also know other businesses, whereby you need to risk something, of course, to get something. What you should know when you're trading Forex is traded in contracts, or it's referred to as, we trade it as a CFD, that is contract for differences, or contracts for difference. So we are actually not literally trading an underlying asset, okay? So meaning that we are trading contracts. These contracts are literally defined by the number of units you're exchanging one currency for the other. Remember, when we are trading Forex, we are dealing with currencies, and for you to trade currencies, there should be two currencies, one being the best and the other being the quote. So for you to definitely trade this particular pair or these particular currencies, you must be certain of how many units that you're exchanging, which later are going to define how much we are supposed to risk per trade. So with this, for us to know how many units we are exchanging, then gives us the lot size, which lot size is appropriate to how much we are supposed to risk. For instance, let's say you want to risk $10 on a particular trade. So for you to risk $10 on a particular trade, you must be knowing your entry, you must be knowing your entry, you must be knowing your exits. That is where you put your stop loss and where you put a take profit. So today, where you've put your stop loss is not the same point where you put a stop loss for the next trade. That is if probably you're not a scalper, or you're not using any other trading system that probably requires a certain number of pips. So what I'm saying is here that let's say you're risking $10 and you want to risk $10 in trading CFDs, especially when it comes to Forex. There is no way you're going to find that there's no way you're just going to suddenly come and put the $10 there. No, it's not going to happen. So what is going to happen is, or what you will see there, is actually going to be volume or the lot size. So it's this lot size, like I've told you, that determines the $10. So it has to be appropriate. It has to be appropriate to the number of units that you're exchanging. So your job is actually to calculate the appropriate number of units with regards to the lot size, and also with the amount of money you want to risk. So the easiest thing is actually to know the formula I'm going to deliver, I'm going to provide, that I came with, of course, to help you know that if I'm going to use $10, I'll use this lot size, which defines the number of units. So your job is not to know the number of units because it's something hard. Your job is not to know the number of units that you're going to exchange. Your job is to know that, yes, if I want to risk $10 on this particular trade, then I should use this lot size. Because, so don't get stuck that, you see, if let's say 0.001 for Euro USD is $10, it's not going to happen. Okay, if it's on Euro USD 0.001 for a certain number of pips as being $10, as an equivalence of $10. When you go to GBP USD, it may be something different. When you go to NZD USD, it may be something different. So today it may be 0.01 with an equivalence of $10, but when you go to NZD USD, you may get something different. So the importance of this video is to know which lot size are you going to use, which is a calculated risk for every trade. Remember, if you're trading as a professional trader, you have to calculate the risk per trade. In other words, you are as a businessman. You are like a businessman who actually goes for a calculated risk. So it's not important for you to always just guess the lot size that you're going to use and all that. So it is your job to know that if I'm going to trade, I should know how much I'm going to risk. I'm going to risk that is using the lot size that is appropriate with what you actually want to risk on a particular trade. So I'm going to go to the board and show you how we calculate this. I believe by the end of this video, it's no longer going to be a problem to you. If you like this video, please share it, okay, as such that also other people can also benefit out of this. So let's get onto the board and we see how you're going to learn to calculate your lot size, how you will determine how much, like how you're going to determine the $10 you want to risk on a particular trade, and regarding also to where you want to put a stop loss. Because let me also have the supplement. Most people are actually driven by the lot sizes. So they're like me, I use a lot size of this and this and this. That's not how it should be. The lot size should actually be varying, provided the risk doesn't change. So if in your trading plan the risk per trade is, let's say, 3%, and that 3% is an equivalence of $10 of your account, then you should go by that, regardless of where you're putting your stop loss. Most of you are actually driven by lot sizes that are provided. I've used this lot size, then I'll just put it there and, call that, which is a general problem. So join me on the board and we see how we calculate this. Yes, like I've told you, we are onto the board, and basically what I'm going to do is what you should exactly do. So behind me is our pie chart, and just like the way I've indicated it here very well, a roadmap to trading success. So these are some of the things. This is what exactly you should do in the video. Just copy what exactly I'm providing to you and apply it in your trading. Believe you me, you'll give me results. Consistently, you give me results. So behind me, like I've told you, it's a pie chart. And like I've told you, a trading system, an effective trading system that is being followed, that is, being proven, back tested, carries 10%. And a lot of guys on video, rather a lot of guys on social media platforms, a lot of guys here and there are looking out for perfect, holy grail videos, okay, rather trading strategies that are 100% perfect and all that. So my point here is an 100% trading strategy that is effective carries 10% of your trading success. So for you to be successful, all you need is 10% for any trading system. So it's not the trading system that's to say that makes you money. For you to be successful, you at least need to carry something that that carries 60% of the trading road to success, which is the trading psychology. So trading psychology carries 60%. Now I'll create a video specifically for trading psychology, but for this video specifically, we are going to look at this section where we have the risk management, money management, stroke position sizing, knowing how much you're supposed to risk. Remember, like I've told you, if you consistently calculate your risk per trade, you with also proper risk to reward ratio that is effective and applicable then believe you me, there is no any one way you can blow your trading account. There is no any one way you can actually fail to be successful, because so many of us are not patient. We have a short-term plan for our trading. We are not patient. We are not persistent and all that. That's the reason as to why most of us fail to make money in the financial market. So when we come to the risk management, money management, like I've told you, it carries 30%. 30%, if you only do this and you insist on it, you already have 30%. So you can have a 100% trading strategy that will only yield you 10%, but with a good risk management, money management, you will have a 30%. So let me show you what we mean by good risk management, money management. Now, when it comes to good risk management, money management, the only thing or what we are talking about is knowing the exact lot size you are supposed to use when you are trading, because we don't know which lot size that we are supposed to use. Like I've told you, it determines the number of units that you're exchanging, but you as a trader, you don't need to know the number of units that you're exchanging. Your job is to know which lot size am I using appropriate to how much I'm risking on this particular trade. Now, here is the formula. Here's the formula. Please use this formula. It works 100%. So here's the formula I have actually discovered. So it goes like this. Remember, this alone contributes 30% to your trading success. Okay, so we have, like I've told you, this formula gives us the lot size that we are supposed to use. So your job is to know where you're going to put your stop loss, how much you're going to risk in dollars, which pair are you trading, and how much your capital is. So those are the few things that you should know. Then after that, you will be in position to get the appropriate lot size that you want to use. So to get the lot size that you want to use, first you will determine your equity. Equity is the capital that you are trading with. Let's say we have an equity of, let's say, $1,000. So after knowing your equity, the next thing is you're supposed to know how much you should risk per trade, not the entire risk, because some people go into trading and they actually risk 50%, they risk 80%, others they risk all the entire equity. So you are not supposed to risk all the money. You're actually supposed to risk between 1% to 3% of your capital. If, let's say, you're a really, really aggressive trader, you should then at least go for 5%. But I don't recommend this. That is if you're aggressive. I don't recommend this. This is usually what I recommend. But then if you think you're impatient, you're that impatient, I know sometimes, it's hard, to go for, to consistently do certain things. At least try your level best and push. Okay. So if you that impatient, at least then risk 5% of your capital. So you can't do over 20 trades and all losses. That is after you've calculated them properly and you go for 20 currency pairs and you lose that money. So it's hard. So I do recommend, at least if you decide and you're that aggressive, go for a 5%. Now, after knowing your equity, the risk per trade we have discussed, so I can probably risk 3%, and 3% is actually 0.3. For simple mathematics, it is actually, so that's where I've actually gotten. So that's where we actually get 0.03. That is 3%. So get your 3%. We have gotten this as 1,000. We have our 0.03. Then our next job is to know the pip value. Now, what is a pip value? Now, when we are trading Forex is actually has its standard units of pips, okay? And each pip has a dollar value. So as prices are moving up and down in the financial markets, we don't say that the market has moved $10. We don't say that the market has moved $5. At least what we can say that it has moved 10. Then this 10, after knowing the value of each pip, let's say if each pip is $1, then you can certainly then say, you know, these are $10. So the pip value is the dollar value, and it is different for each and every pair. Okay, so the pip value for Euro USD isn't the same as of that of NZD USD. So it's your job to get these pip values. Well, I'm going to show a link below where you're supposed to get these pip values. So apparently now what you can see in our formula, we actually know this. You're not supposed to get it anywhere. You know this, and you know this. So let's say the pip value for Euro USD is $10. That one, every person knows that. So the pip value for Euro USD is $10. Now, if it is $10, it means that in the whole formula, the only thing that you should actually look for, search for, get is actually the pip distance. And pip distance is actually the number of pips from your entry point to where you want to put your stop loss. So if it's your job now to use the crosshair, I released the video still about, measuring the stop loss. So just check within our videos. You've been positioned to. So you just need to use your crosshair. To use your crosshair, like, it's very easy. Measure the number of pips that you want to risk. Measure the number of pips that you want to risk. After knowing the number of pips that you want to risk, let's say for this case scenario, we want to risk 10 pips. So come here and put 10 pips. Okay. So of course, when you do this, so we said our equity was that times 0.03 times 10 times 10. So here becomes 30. So 3% means that you're going to risk $30 on this particular trade. Remember, by us doing all this, what we are looking for is just a lot size. So when you divide, when you get the 30, you divide this 10 times 10, that's 100. So when this cancels this, of course you will see that we'll be using a lot size of 0.3. So it's very easy, it's very simple. So for those of you that have been literally just don't know how to use an appropriate lot size with regards to what they want to risk, and also basing on where they want to put the lot size, is basically as simple as that. So you've seen we have entered our lot size, rather we have got our lot size basing on the risk that we are, rather the capital that we have, the risk percentage, that's the amount of money we want to risk from our capital, the pair, there is consideration of the pair, and also where we want to put our stop loss. So when you just go onto your chart and put the lot size by putting the stop loss where the 10 pips is from the entry point, you definitely realize that you only be actually risking $30, which is 3% of your trading capital. Okay, so it's a very easy formula. It's a very easy process and very simple. Okay, so I think I'll be still also releasing a video on how to get an appropriate lot size from TradingView in just 2-3 steps, which becomes a bit easier for those that literally know how to use TradingView and all that. So we assume you've done this onto your paper. You just need to go to your platform and do everything. So everything is simplified for you, and your job is to make sure that when you go in for another trade, you do the same, because today it may be today it may be this, but then on the next day or in the evening you've gotten a different pair. So with the evening and you're trading a different pair, it means that these two are not going to change. That is the capital and the risk percentage per trade is not going to change. What is going to change are actually these two. So maybe in the evening you're trading USD NZD, Probably the pip value may change, and also where you're putting your stop loss may change based on different factors that may vary. That is maybe due to factor of support, resistance, supply, demand, moving averages, and all that. So it's as simple as that. Please master that formula: equity times percentage risk divide by pip value times pip distance. All this gives you a lot size. Please like, share, and subscribe. In case you missed out on something, you don't understand, you're finding difficulty, use the contacts in the video to contact me. I'll be in position to help out. If you find this video interesting and helping, please share it to the rest of the other people such that they also benefit out of this. I stay Isma. I do love you all. I sign out.